In December 2021, I did 2 videos asking whether it made more sense to overpay your mortgage or to invest any spare money you might have. Now back then, the Bank of England base interest rate was 0.1%, but as I record this, it's 4.25% and probably heading a little higher yet. Mortgage rates have followed suit, of course, so I think it's time to revisit here in spring 2023, does it make sense to overpay your mortgage or invest? Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Build Wealth. More on that in just a little bit. And sorry it's been a week or 3 since the last video. COVID finally got me. 3 years, managed to avoid it, but it got me and it smacked me around a little bit, so thanks for your patience. Now if you've watched the previous videos on this subject, you'll know that I major on 2 key factors when it comes to making the decision whether to overpay your mortgage or invest. Those 2 factors are maths and emotion. So let's do the same again, and we're going to start with the numbers behind the choice because it's those that have changed the most since last time. So same as last time, we're going to assume that you find yourself with £250 per month excess disposable income that you've got to decide whether you're going to put it against your mortgage or whether you're going to invest it. And we're also assuming a £200,000 mortgage over 20 years, and we're going to use the average 5-year fixed rate in the market at the time of recording in April 2023, and that's 4.86%. And that's going to cost you in the region of £1,300 per month. Now, if you overpay your mortgage by £250 a month, you will pay it off 4 years and 9 months early, and you'll save £29,940 in interest. Now, if you invested the money instead, your outstanding mortgage balance would be £67,710 after the 15 years and 3 months, whereas your investment pot, assuming a 5% return, would have £68,699 in it. So, you'd be £1,090 better off by investing, which I don't think is a significant difference, especially as investment returns, of course, are not guaranteed. Now, obviously, if you get a better return than 5% a year, it's going to skew the numbers even more in favour of investing, but the reverse is also true. But if we look at things over the full 20 years, if you invest £250 a month at a 5% return, you'll end up with £103,186. But if you overpay and get rid of the mortgage in 15 years and 3 months, then you divert all the mortgage payment and the £250 a month extra into an investment, well, at the end of the 20 years, you'd have £99,905 in the pot. So again, you'd be better off by investing versus overpaying, but only by £3,281. And over 20 years, I'm not convinced that that is that material. Now, these numbers are much closer than they were back in December 2021. No great surprise there. If interest rates come down again, it will skew things in favour of investing even more, I think. But I wouldn't expect rates to come back down to where they were 18 months ago anytime soon. So if the maths is less clearly in favour of investing than it was, still in favour, just a little bit less so, if that's the case, then what are some other reasons that you might invest rather than overpay? Well, having money in a pot that's accessible gives you flexibility. That's really a key word here, I think. You might not be able to draw overpaid mortgage money back down very easily if you were to need it in a pinch. You would likely incur remortgage costs unless you've got one of these flexible mortgages where you can dip in and out. With an invested fund alongside you, you could use that to reduce the mortgage balance when your fixed rate is up, rather than doing it as you go along. You do, of course, run the risk of markets being distressed at that time, though, which is when you really don't want to be drawing off your investments. By the way, for anybody in America watching this and wondering what on earth I'm talking about, in the UK we don't generally have access to super long-term 20, 30-year fixed rate deals. Usually the longest we can fix our mortgage interest rate for is 5 years. Okay, I think there's some good reasons still to invest, but what about our other factor, the emotional, psychological benefit of paying off debt? Has that changed much in the last 18 months? Well, I really don't think human nature has changed in that short time, so yes, it's still a very big factor. What has happened since my last videos on this subject is that the cost of living has risen significantly, and there's arguably quite a bit more uncertainty about job security in many quarters. I think things just feel more difficult for many of us at the moment, and chances are there are far fewer of us who are in a position to overpay than there were when I did the previous videos. But if you are, I can see that there's likely to be even more of a draw and attraction to use that extra money to reduce your debt burden. I remember back in 2008 in the great financial crisis, people switched almost overnight from spending to really aggressively paying down debt. Now, I don't know if that's happening to such a large degree now, but I certainly wouldn't be surprised. I think this is more likely to be driven by pragmatism than emotion. I feel like when things are tough, or at least uncertain, we're more likely to make pragmatic decisions than ones driven by more subjective, touchy-feely emotion. And I think that's probably likely to lead more people to invest, or perhaps more so, just keep money in cash in the bank. After all, you can get 4.35% interest in a 2-year fixed-term deposit account right now. And that's not much less than the average 5-year fixed mortgage. So this is not even about investment risk. That's a guaranteed return. It's in the bank. And the first £1,000 of interest you earn each year is tax-free anyway, if you're a basic rate taxpayer. So what are some other reasons to overpay? Well, if you overpay, you're going to be reducing your mortgage outstanding balance more quickly. When it comes to remortgage time, you'll potentially qualify for lower rates. And managing your mortgage well as you go along will lead your lender to look favourably on you should you get into difficulty and need to request a payment holiday. Remember, there's a guaranteed saving of interest if you overpay versus a very much not guaranteed return if you invest the money. That's really important to remember. So, where are we coming to, again, in this discussion? Has the conclusion changed? Well, before we get into that, if you're in a position to pay down debt, invest for the future, and have a plan maybe to retire one day, then check out Meaningful Academy Build Wealth. That's my focused course, which contains the most distilled learning about how to secure your financial future. It's a course that you can take at your own pace. There's video lessons, calculators, worksheets, live Q&A calls with me, and a thriving community of people in a similar situation to you, all looking to help each other out. And there's also access to the financial planning software tools that I use every day with clients. It's called Voyant Go. It's super powerful, but easy to use, and I'll teach you how to use it. So find out more at meaningfulacademy.com/buildwealth, and if you decide that it's for you, use the coupon code YouTube for a decent discount. Okay, let's talk about inflation for a sec. As I record this, inflation is starting to come down, but painfully slowly. Our Prime Minister and Chancellor have as their number one goal to halve inflation by the end of 2023. Now that's probably going to happen without them having anything to do with it, but you just know that they'll take credit when it happens. But remember, that doesn't mean the cost of living is going to get any cheaper. It's just going to rise more slowly. We could potentially end up with a period where inflation comes down lower than interest rates. That's pretty rare. But if it does happen, then potentially it's possible to benefit from keeping money in cash, at least for a short time. Remember, normally, if you keep money in cash in a bank account, you're still losing money because inflation is usually higher than the interest rates. If that reverses, then you can make money by leaving cash in the bank. But it'll only be for a short time if it happens at all. I think this would mitigate in favour of not overpaying your mortgage, actually. But I don't think it's a situation that's going to last for long, even though I don't think that the Bank of England is going to rush to reduce rates too quickly. They're going to want to be sure that inflation is very firmly on a downward trend. And in any case, banks, as we know, are notoriously slow at passing on rate falls to their borrowers, even while they're really quick to pass on rate rises. Inflation reduces the real value of debt over time, remember, so we do want some inflation, just not too much. Okay, let's wrap this up. In short, the mathematical difference between overpaying or investing has narrowed. It's much less clear-cut in favour of investing than it was when interest rates were lower, simply because you're saving more interest now if you overpay. But in difficult times, flexibility is going to be the key. And having money to one side, either in savings accounts or investments, gives you the option to dip into it to top up your income or to pay a chunk off your mortgage when it comes to remortgage time. And this is more flexible than overpaying, when you might not be able to take that money back out again to use day to day. I think that now more than ever, it's important to think holistically about your finances. That flexibility gives you options. You get both the benefit of building up a pot, plus the option to pay down debt in lump sums if you want to. And as ever, remember the decision to overpay or invest actually doesn't have to be an either-or decision, not in practice. You could just split the difference and do both. Okay, I hope that was helpful. If it was, you know what to do. Hit the like button and subscribe to the channel if you're not already, and maybe share this video with a friend if you think they'll find it useful. Thanks so much for watching, and I'll see you in the next video.